What's going on, everyone? You're watching a recording. Got my boy Paul in here with me. Just want to run through some quick things. For those of you that haven't been trading, haven't started to trade, this is your first time, I want to go through some of the best brokers that we use and that are the most reputable, best bet to be trading with, and honestly, easiest platforms to get signed up with. The main three that I would ever recommend to anyone would be FX Choice. You go to myfxchoice.com, Google myfxchoice, and you can create a demo account through them or go live. Very, very good broker. You can get your trade lists in the back office. You can get many different deposits. It's really good broker. No market manipulation. Just all around good customer support, good broker. Another one that I would highly, highly recommend is KOT Forex. You can go to KOT4x.com. Again, you can sign up with them. They offer crypto trading, they offer stock trading, indices, and there's a really low deposit minimum. And also, they are very, very good. Awesome customer support. I've had to contact all of these customer supports on several occasions just for different things. They've all been very helpful. And honestly, another easy one to get set up with. And last but not least, our boys AAFX. You can go to aafxtrading.com. Same thing, you can open a demo account, open up a live account, multiple different funding options, super good brokers, all three of these. And yeah, just go through, create a demo account. Be sure, if you're trading on your laptop or your phone, you can do both, to get MetaTrader 4. This will be your official gateway into getting your trades, linking your accounts to brokers, or your broker accounts to your trading. That's how you'll place all your trades through this app, MetaTrader 4. You can get it for Windows, iOS, Android, MacBook, whatever you need, wherever you're trading from, you can get this app. You will 100% need this app. Then when you sign up for a demo or a live account, they will email you your login info. You just go onto MetaTrader, plug that in, linked up, perfect. And yeah, those are the three brokers: FX Choice, KOT4X, and AAFX. All very good, all very reputable, all highly recommend, and each have their own benefits and disadvantages. Do I recommend one over the other? No, I don't. Like I said, each one has their own benefits and disadvantages. Each one has different funding options. Each one has different back offices. So whatever you feel like using, pick it. And then, going into our training, I will be going more in depth on support and resistance. How I'll do this, you'll see, but there's more to support and resistance than I've already previously taught you. And then I'll be getting into some Fibonacci, and I will also be getting into candlestick analysis. What candles mean, how it looks, how you should be looking at it, stuff like that. Without further ado, let's go into support and resistance. So, support and resistance, as you know, is where the market likes to turn around at. Prices, levels that the market likes to turn around at. What this will look like is, you can imagine two parallel lines, your train tracks, and what happens is price will come in, price will do its thing, and it will hit these levels, and it won't want to get past them. And we can identify these fairly easy. Sometimes it can be a little tougher, and you can trade off of these levels. this is a very basic way to look at support and resistance. This would be your resistance, and then this down here would be your support. You'll also be hearing these called supply and demand, ceilings and floors, but you can think of support as like a basketball. You drop the basketball, and the basketball bounces off of this support, off of this floor. If you throw the basketball up into the air, it's going to hit a ceiling or find resistance, and it won't want to go past that because that's the cap. Then there will be instances where that basketball will actually break through and then start to use that ceiling as a floor or that resistance as support. And you can see this happen everywhere in the market all the time. And it's a very, very reputable, very good way to use technical analysis. One way that I always explain to my friends, to students I'm training, is price likes to remember. Price has a memory. So what that means is, think of it as if you were in an airplane. So you're cruising, and you do your takeoff. You get to your cruising altitude, and then all of a sudden, you drop 5,000 feet out of the air. You aren't going to really specifically remember any of this back here. You aren't going to really remember takeoff to really here. What you're going to remember is this sharp drop off where you fell 4,000 feet out of the air in your airplane, because that's going to scare the living shit out of you. So price does the exact same thing. Price will remember these times where it jolts from prices and also drops from prices. It remembers this, and this will also help identify your support and resistance. So if you dropped 4,000 feet out of the air, something happened there. And you can also think of this as like driving along the highway. You're driving along the highway and you're cruising, all of a sudden you see a cop and you gotta slow right down. So something happened right here that made you slow right down. Then let's say you're taking it the next day and you're cruising, and boom, again. Or you can even have it look like this. You're cruising, and boom, again. That cop's hanging out at the same spot. Something's happening at this one level that is making you slow down. And that's kind of what support and resistance is, and how price remembers these levels, and how you should kind of be looking at the market. Sorry, I just got a text from my girlfriend. So when you're looking at the market, you want to be finding these key levels of support and resistance where the price is drastically dropping off, or the price is sporadically taken off from. These are levels that you should be keeping your eye on, and these are levels that you should be using in conjunction with other technical analysis tools, like your trend lines and your other theories that I'm going to be teaching you. I know Paul is the only one in here, but Paul, do you have any questions about that? Does that make sense how I explain that? Okay, perfect. It makes a lot of sense. So that's how we're going to get more in depth with this support and resistance theory. On my last call on, what was it, Thursday, Tuesday? I'm not even too sure. But I did a call a few days ago, and it's my most recent call to trade with me. And I was looking at gold. And I specifically said that gold let me go to my main chart because I did the markup off there. So I specifically said on gold that gold had this area of at 1400 where I can really see things kind of taken off from. And what happened, let me find this again. So I was looking, and I was finding these levels. So 1400 was a level that stuck out to me. We have sharp drop-offs, we have key areas, a lot of wicking happen on the specifically weekly candles. So in a week, these candles were getting up to this price and were getting rejected. And again, time and time again, was getting around that 1400 area, and price just didn't want to break through it. Then we finally broke through it over here, had some wicking again for 2 weeks, 3 weeks. And then what I was saying was 1400 is an area where you can definitely be seeing the market drop down to before the next push up. I thought it was going to take a little longer, but needless to say, technical analysis stayed true. I believe I called this around here where this was going to happen. Or maybe it was here, and that's where the... Regardless, it came back down to this 1400 level. Never actually touched the 1400 level, just wicked around that 1401 level before just taking off for a massive, massive jump in price over the next 1, 2, 3, 4, 6 hours. We've seen an increase of over 400 pips, over $40 in price on gold increased, and you could have made a shit ton of money. Unfortunately, I was working, so I missed that whole move, and I wasn't able to watch the market. I didn't have any alerts on because I'm very silly, but needless to say, this technical analysis held up with this area of interest of 1400. And one thing that I do want to mention, that I mentioned in my last call with Matthew on Thursday, I believe it was this idea of institutional price levels. Now what this means is, let me get onto this chart because it was being nice to me. You know, what that means for institutional price levels is you have these levels where institutions, big banks, are pushing levels, price to these levels. Institutional. But what these levels are, sorry, I can't spell. It's been too long since I've been able to spell. Okay, let's just keep it at inst levels. The institutional price levels are these levels that banks and institutions and big players in the game that are trading millions and billions of dollars in one trade. They like to push the market to these specific levels and use these levels against us. Not a lot of people know about this. A lot of it has to deal with psychology, but they'll play these levels against us, and these are levels that we need to be looking out for. So these are your 20, your 40, your 60, your 80 levels. It will also be your 00 and your 000 levels. And sometimes it will be your 50, but that's more of a psychological level that also relates to quarter theory. And what quarter theory is the theory that the market plays within 50s of each other. So on a currency pair, it will be 50 pips that the market, each 50 pips that the market will use as support and resistance and key levels to play from. There's many traders who use that quarter theory idea, and I've used it myself. It all just depends. Each tool that I'm teaching you, you will be able to use at some certain point in conjunction with other tools and skills that I'm teaching you. But these institutional levels are the 20, the 40, the 60, the 80, the 00, 000, and sometimes the 50. And what happened here is the 00. it was also another double zero because it was that round even number. If you go down to a smaller time frame, you'll be able to see price play off of the 40, the 20, then also the cent marks. So we can go to, like, let's say US CAD, and it's actually playing on an institutional level right here. I mean, this was actually quite a good example. I can't find my hotkeys. So institutional level right here at 13. Whoa, not what I wanted. At 13 or 132. And you'll be able to see how these levels just play with the market and how they'll move the market to these levels. That's a 20 level and also a 000 level, because that is 1, 3, 2, 00. So you have that 20 level and the 00 level. 20 and also that 00. So that's all. That's really good thing to be looking at, is looking at these round pip numbers, your point numbers, however you want to describe it, and see how it related to the market beforehand. And you can see how this has correlated with the market in previous scenarios, where 132 was used as a level of support and resistance at some point in the market and was a key level to be determined in trades. It was used right here, very good. It was used here, there. Then it wasn't used for another, what is that, year? That's 3 months. Not used for another 4 months before it came to this level. Then it wasn't used again for another month, 40 days before it was used again. So these are levels that you can keep an eye on. And again, those are your 20, 40, 60, 80, 00, 000, and 50. It's going to take some time and some practice to spot these levels, but I really want you guys to start incorporating this into your technical analysis and really be trying to further progress how you see and read the market and price levels, and also aligning it with previous price data like I did with this 1320 or 3132. Sorry, I can't talk. And I only seen it right here, but it gave me years of data when I zoomed out and looked at it at a bigger scale. And I mean, it was even being used back in 2016, 2017. I don't believe the market went that high before. Okay, yeah. So, I mean, even on a weekly time frame, you could say that this, oh, perfect, the 130 level, a very good example of how price didn't want to break that 000 mark, because 130, that 1.300 is a 000 level, where price just didn't want to break that level. And if you highlight this, you can also see how that has been used in previous market datas, where price will just get pushed back to it. Paul, do you got any questions on that? Any comments? I kind of tailoring this for everyone, but you're the only one in here, so you really have free reign to kind of ask away and how you can incorporate this. But if everything's making sense so far and how we can use these institutional levels to incorporate, I don't, but definitely need time to see. Yeah. Yeah, like I said, it really takes an eye to see these levels, especially on the different pairs. Like the non-yen pairs will be different than the yen pairs. Then, I mean, commodities like oil and gold and Bitcoin and indices like US 30, S&P 500, those are all different beasts that you need to be looking at, but I highly suggest starting with the yen pairs, like the US yen, the euro yen, CAD yen, then also all the non-yen pairs, so US CAD and everything else. Those will be your easiest for training your eye before you step into things like gold and oil, because those get counted in different ways, and I don't want you getting confused with institutional levels of gold versus institutional levels of currencies. So when you're practicing these and learning them, please stick with the currencies till you kind of really understand how to use them, and kind of get a week or two of testing them out with demo trading and just seeing how these levels can play into technical analysis before you really start taking it to the next level of using it on, like, let's say US 30, where this thing will move freaking thousands of pips in 30 minutes versus a yen or like a regular currency pair that will move 10 pips in 30 minutes or 100 pips in an hour. On a very volatile day, 100 pips in an hour. So just keep that in mind when you're practicing this, to just stick on the currency pairs. And again, the 20, the 40, the 60, the 80, the 00, 000, and the 50. Those will be your institutional levels. Let me just check my notes, see what else I had in store. Fibonacci levels. You'll see me using Fibonacci levels quite a bit in my technical analysis and my entries and my take profits. It's a very, very good tool to use, but you want to use it in conjunction with other things and other technical analysis resources. I will be right back. I gotta let my girlfriend in. Sorry. Yeah, there's only one bag. It's being recorded for everyone else. And saving this. Okay, I'm back. So, next on the list is Fibonacci levels. Fibonacci levels are very, very good to use. Fibonacci levels are very good to use, but like I was saying, you want to be using these in conjunction with other things, like your trend lines, your support and resistance, your price levels, if you can align it with an institutional level and see how price reacts off of it. Very, very good. I had a recent example on the DXY. This is the dollar index. I will go to Discord to show you how I use this. I think it was on my main chart, so I'm going to need to load that too. It gets really confusing when you have two charts that you trade off of and do markups on, because you kind of forget where you do all your stuff. But I made a very in-depth post about this on how I was trading this. So if you go into Pippin Ain't Easy and Scott's list, this is my list where I do full technical analysis, going very in-depth on how I do everything. It can be long-term, short-term, I recently posted NZD stuff and what I'm seeing for that, but for this specifically, I said on June 25th, we can potentially be seeing a retracement to make a lower high confirming a bearish sentiment on the DXY. What this means is just I seen an overall downtrend in the market, and I wanted to confirm it with a retracement that was taking place. And this was used for a trade on the GBP USD pair, as you can see here. And what I was looking for was MACD divergence, and I wanted a retracement to the 50, the 61.8, or the 71. And what happened was actually all the above. So I had a trend line. It was more of a 4-hour trend line. And what I was seeing was a short-term bearish sentiment, so a downtrend sentiment in an overall uptrending market. Uptrending being it's making higher highs and higher lows. You can kind of see the general direction here where it's just trading upwards. We did see this breakout of this channel. I mean, I'm sure I don't have this channel set proper. Yeah, no, I didn't have this channel set proper. But we did see it come down to test these lows. And what I really wanted to see was a retracement back, confirming really a lower low. We didn't end up getting a breakout to the downside as I was hoping, but we were also still trading within this channel, which is what I like to see, confirming just market structure, market liquidity, stuff like that. I can really see this coming up in the future to test this 100 level, kind of meet in the top here, seeing this come somewhere within here, this range. And so, as I was saying, what I was seeing was I was wanting a retracement back to these levels, specifically the 50, the 61.8, and the 71. And why these are important is because Fibonacci is a part of everyday human life. So you can see this in the human body, in DNA. It was developed by a famous mathematician back in like the 1800s. No, not 1800s, the 1200s. And it's just a mathematical sequence of numbers that repeats itself through nature and through just everything. So, I mean, I'm not really going to get into all of this, but you can see it in horns, galaxies, pine cones, ocean waves, the human body. It also aligns with the picture-perfect theory or the golden ratio. You can see it in tree branches and just tons of stuff. You can even see it in memes now. But yeah, this comes in all different shapes, forms, sizes within all of nature. And someone said, hey, does it happen in trading? And sure as fuck it does. So this is something that you really want to kind of be looking at also with your technical analysis, but not solely using, because everyone else kind of knows about this too. So just specifically relying off of Fibonacci for your trades is not a smart idea. But like I said, when you put it in conjunction with other things like technical analysis of support resistance, price levels, institutional levels, trend lines, stuff like that, you can get very accurate trades and really further your success as a trader. So what we did end up seeing was we seen price retrace back to the 50, the 61.8, and the 70 level. And I was actually in a buy back here. It did take a little while for it to break out. It took about a week, but then we've seen a major spike over the next 8-9 days. That gave us that 50, the 61.8, and the 70 level. Then, of course, it just continued to push further. Any questions so far, Paul, for Fibonacci? I'm sure you've seen a lot of it in your experience as a trader so far. Do you want to, I'll kind of go more in depth on how to use it to your advantage, but this is just an example of how I've used it that actually has panned out and worked for trades. So I believe on this, I'm looking at a retracement. Let me get my fib tool. We are definitely good. Okay, good to know. So on US CAD, I'm looking at a retracement right now. So I do like to do a little extra with my fibs. I like to align it with price levels. And we can put that maybe. So I like to just kind of place it on those nice price levels, the institution price levels that we talked about earlier. And that kind of helps get me a little bit more accurate fib levels. And what I'm looking for is a retracement at this 50 level before I start to looking to get in a sell position. Because if you've been in any of my recordings, if you've seen any of my posts, I am very long-term bearish on US CAD. So I'm really looking at a sell setup for US CAD to take place. I'm looking at this trend line that got broken, aligning with the system that I'm teaching you of the trend line with the MACD. And I'm looking at this to potentially get to 50 or 61.8 or 71 before we can start to get into another sell position. I have already shorted the market from up here. I don't think I got in there, but I was in a sell here, then I end up taking profit down here. But I still am in the sell here and here, and I'm looking at getting into another sell somewhere within this area to kind of ride that down further. So I would say that we are kind of forming this flag. If you were in my last recording, I beat the hell out of you guys with learning flags because it's a very important structure that you should know. But we got our impulse from here, and we're getting our accumulation right now before the next drop. And the accumulation is kind of where you sit on the sidelines and wait and see where you can hop into the market. And that's kind of what we'll be doing. Like I said, I'll be looking at 50, 61.8, 70, and just kind of seeing what price we'll be doing around there, which leads into the next topic of seeing the bigger picture. By using Fibo, do you only supposed to use buy stop and sell stop? No, what I do is I use candlestick analysis to just justify me entering trades. I know the strategy you're talking about with the buy stops and sell stops with Fib, but this is just using Fib as a whole with your technical analysis instead of a strict trade-in system. So I'm using it to kind of confirm market structures rather than solely trade the Fibonacci. But I know exactly what you're talking about. But that I won't be covering that in the training. any of the sessions actually, but just so you know, I do know exactly what you're talking about, but that's not what I'll be doing. So as I was saying, I'll be looking at these key levels. Again, the 50, the 61.8, and the 70. I use 70.5 as I've been taught by my mentors that is a institutional level. And these are the 3 levels you should really be watching for. You will see some reversals at the 38.2 and the 78.6, but I mainly just use these 3, 50, 61.8, and 70.5. I've probably said that a million times already. But what this will lead into right now is seeing the bigger picture. So with these candlestick formations and these candlestick patterns, you can start to see different scenarios on different time frames, but you want to be confirming these scenarios with also those other time frames, if that makes any sense. So like a doji pattern or a spinning top, these are both reversal patterns, specifically a doji, where you'll see, actually let me try and find one. Let's see, doji, right here. So this doji here on July 18th, I'll place that there. As you can see, we had pretty much market open and market close on this candle, pretty much identical. And if we hop down to the 4-hour time frame, we should see something like this. So the doji should look something like this, with a wick almost identical on both sides. Now on a higher time frame or a lower time frame, that same candle will look something like this, where the candle open and candle close are the same, but within that specified time frame, it's made a high and has made a low, but has closed at relatively the same area. Now we can use this to help further our analysis and help further our trades. So if we see a doji happen on the 4-hour, and we see, where did that go? So that would have opened right there. And then go 1, 2, 3, 4. So this is the movement that we're seeing here. These 4 candles. So what you see here is the candle, the 4-hour candle would have opened on this candle. Then you get a market push in the favor of the direction we're looking for. Then this rejection down here. Now, like I said, you want to be using everything in conjunction with something else to further your technical analysis, to further your strategies, to further the probability of things working in your favor. That being said, we are at this specific moment in time. It looks like we're using the 30-20 level as a level of interest, as a level of support. And what we've seen is the market come down and just use this level heavily as support. And what we get is this doji candle formation. Where did that go? 17th, yeah, this doji candle formation right on that level of interest. And with everything lined up to say, hey, like we might be heading upwards, this is a good indication that you should be looking at getting into a buy, specifically after this doji candle forms and the next candle goes in the favor of what you're looking for. So in this case, it's a doji candle that is confirming a bullish or an uptrend to get in for a long position. And what we used was this here. It bounced off here. You would have had your market, your 4-hour candle close on this candle. So the next 4 hours, you're waiting for it to close in a bullish scenario. And what you see is just that, a bullish scenario take place, and then you're hopping into the trade. You would have waited for these 4 hours, and you would have hopped in right at this open. And you would have been pretty well off very fast and been able to capitalize on some profits. Now, reiterating what I just taught you guys about Fibonacci, is if you take from your high, your swing high, to your swing low. Let's line this up with the level. I'll say 30.94 and 30.20. So if you use this in conjunction, going from high to your recent low, you get this doji candle confirmation. Where did this go again? So you get this confirmation, and you got this. Now you're looking at to be taking profit around the 50, 61.8, and the 70. You could be looking at 100% retracement for your final take profit, but these three levels, specifically 50, 61.8, and 71, is where you can start to be looking to take your profits at when you're using a analysis like this. So you get your impulse down, you get your rejection, your doji candle, and you're hopping into the trade at this candle close, because you want to be confirming that, yeah, this is going to be going in your favor. I would place my stop loss under this low a little bit so it gives some breathing room, and you got a nice risk to reward if you're going to any of these 50, 61.8, or 71 levels. Again, all of this is going to take a lot of practice. None of this is going to be implementing and seeing the right things happen. It's going to take time and a lot of failed trades before you start actually seeing a lot of this stuff working out. I can say this from experience because I've done a lot of trades, tons of trades that haven't worked out, but then I've taken a lot of trades that have, just in this specific manner of using these trading tools that I'm teaching you. And that in general is what you should be looking at, is going from high to low time frames, looking at the general direction of the market, where you want to be getting into, where the market might be heading to. It's really tough to say when you first start looking at charts and you first start looking at the daily and the weekly, but you don't want to be starting your analysis on the 15, because the 15-minute can tell you one little short story, but the daily will give you the full story on what's happening. Then, of course, you want to be scaling down and seeing what each time frame is telling you. And if all your time frames are lining up to say, hey, we should be selling this, then I'm sure as shit not going to be buying it if my daily, my 4-hour, my 1-hour, and my 15-minute are telling me to sell it. And that's really something that I see a lot of new traders struggle with, is they'll stick to the 15-minute time frames and not look at the higher time frames. That's like going to a museum and standing a few inches away from the painting and trying to see what the painting is. You want to be taking a step back and looking at the whole painting itself before you're inspecting the fine details. And I can really say that's what a lot of new traders do, and I've seen it time and time again. So please, please train yourself to be looking at higher time frames before you're jumping down to the 30, the 15, the 5, stuff like that to be doing your trading. Because each time frame will tell you a different story. And I believe that's all my notes that I want to go over for right now. We went over in-depth support and resistance. We went over Fibonacci levels. We went over seeing the big picture, the time frame, and candle analysis. I showed you guys what brokers to use and how to get in with them. Again, just example, go to KOTFX or Forex and sign up and just open demo account. I don't want you guys to be trading live until you're confident in your demo trading. Again, go to AAFX and you can open a demo with them. You can go to MyFX Choice and open a demo with them. These are the 3 highly recommended demo and live trading brokers that I would recommend. I've had nothing but good experiences with each and every one of them. Each and every one of them have very, very good customer support and back offices and reputability behind them. So please stick with those 3. Don't be going to some shady ones like Hugo's Way, where they're known for market manipulation. Stay away from Hugo's Way, please. You'll only lose money with them, and I can tell you that on a personal level. You will only lose money with them. No matter how good you've been demo trading, no matter how good you've been live trading, they will move the market against your favor, against each and every individual trader. Each chart a trader will look at, we've had it in the Discord, my chart has looked different than another trader's chart, and we've used the exact same broker, Hugo's Way, and it's looked different and it's been manipulated different, and you will only get burned with them. So please, please, please stick to AAFX, stick to MyFX Choice, and stick to KOT Forex. These are the 3 that we highly recommend and that you should be staying on. But as of, see, even Paul can vouch for that. As of right now, that's all I want to go over. Paul, do you got any questions? I know you're the only one in here right now, but this might help people in the recording who are watching it. Did you have any questions about anything I went over? Want me to expand or elaborate? We'll let Paul type out any questions or responses he has. And yeah, please guys, sign up for your demo accounts. Get your MetaTrader 4 on your laptop, your phone, link your accounts, and start trying to mark up some charts, because you aren't going to get good at this unless you start doing it yourself and start post some chart markups in the messenger. Say, hey Scott, what do you think? I'm looking at a buy, I'm looking at a sell, I think the market will do this. Start just doing it. There's no way of getting better unless you start doing it. Honestly, I don't so far, but yeah, and please, 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 write those institutional levels down. Again, if you don't have them written down, they're 20, 40, 60, 80, 00, 000, and just like vowels, your 50 will be a sometimes. So 20, 40, 60, 80, 00, 000, and the 50, and only practice on currency pairs. Because I'm telling you right now, commodities and indices are a whole different game when it comes to institutional levels for trading. And I'm telling you that right now. It's taken me some time to figure these levels out for gold, oil, stuff like that. But it only comes with time of practicing it on the currency pairs. That being said, I hope this was a good recording. I'll have it up soon. And go watch the other recordings. We'll be expanding from here, getting more in depth. And like I said, each one of these trainings will just build the foundation and build each skill more and more. I'm not going to be throwing you guys into the ringer. If you have any questions, if anything doesn't make sense, please reach out. Here to help. And with that being said, have a good night. If you're watching this on recording, have a good day. Thank you. And hopefully you guys are learning.